resume recording. Yes, it will be, and then the webinar will be available for you to, you know, watch at your leisure. So guys, we'll wait for another 2 minutes. We will give some other people to sign in. Did everyone get an email from Zoom? Is there did someone find another way of logging in? Because some people have registered, but they don't get the email from Zoom.
I didn't get the email from Zoom.
So how did you manage to log in?
There was a link, I think, on your confirmation email.
Oh, okay. So I think that's the email that, okay. Sorry, so that was my mistake. So it comes from Zoom, but it comes in my name. That makes sense. Okay. Let me just inform this person.
Oh yeah, it's true.
Sorry, it's you mean it's come from Zoom?
Yeah, it's actually from Zoom, but it shows up as if it was from you.
Yeah, makes sense. So just going to give you guys a sense, we did the same webinar yesterday as well. So we had about 60 people registered, about 45 people were on the call, which was great. And it was quite an interesting discussion. So hopefully we'll have the same interactive discussions today. And what I'll also share is some of the thoughts that people had from yesterday as well. So you have a sense of a bigger group. Today's group, the group now is much smaller than yesterday. So we've got about 25 people signed up for this one.
Yeah, hi. If we just want to hear yesterday's seminar or the discussion, would it be available or?
Yes, absolutely. So we will, what we'll do is we'll send a link to the webinars.
Yeah.
Right. So guys, let's get started. So everyone can see my screen, right?
Mm-hmm.
Yeah. Okay. So guys, for people who are new, we are not investment advisors. We don't want to have trouble with FCA. We are not touching your money. It's a community. We discuss things out. If you want to present, you can present, at our next webinar. And again, we are not experts, with anything we do, but we learn through experience. We learn through experiences, discussions, all of those things. So just to kind of explain, we started off as a small group in London, and today we've expanded to 13 groups, about 6,500 people. And we want to kind of expand it further to bring together, value investors, create a forum where we can discuss and work together. Just on our side, thankfully to, Seeders, which is a crowdfunding platform, we managed to raise funds, and really fortunate that we closed our round before, the virus thing came about. So we have some funding for the next year. So I'm less stressed and losing less hair at this point, which is great. Actually, one thing I should do is I should turn on my video, which I forgot to do. Sorry, so you can see. So one thing we did even yesterday was when we started off, just to kind of sense of, get a poll of who is around. So you will see on your screen a quick polling for you to answer questions. And so we know a little bit more about the group. Can you guys see the poll? Yeah, okay, I can see responses coming in.
Well, I wanted to clarify the first question.
Yeah.
Is it about personal finance or it's in more general?
Stock markets, I think.
No, I mean for your own account or?
Yeah, for your own account, yes. Yeah. All right. Any more before we shut? So not everyone has voted. All right, I will stop it for now in the interest of time. Okay, so let me just share the results with everyone so you guys can see the results. Okay, so some people couldn't see it on the web-based platform. Sorry about that. Sorry, Price. I think it's only in the app then. But the mix is very different from yesterday, actually. So right now we have 50-50 in terms of people less than 1 year and then more than 5 years. Actually, quite a lot of people more than 5 years. So please pitch in your thoughts in this. A lot of people wait and watch. Great. Oh, we've got some people who are shorting one person. That's good to see. We didn't have that yesterday. Okay. Again, this will be shared out in the, so people who can't see it, don't worry, it'll be shared out in the email as well. Okay, so let's shut this poll. So let's move on. So just the poll from yesterday. So as I said, we had quite a lot of people. We had a mix of, 30, like a third for people who were able to poll. And a lot of people were buying undervalued stocks. That was the theme. And this was at the start of the session. Maybe it changed at the end of it. So I've got some feedback, we've been running these meetups for a while. So last 3 years, I've been saying that, I'm not buying anything because markets are overvalued. And so that came across a little bit negative. So a lot of people are like, hey, but you always say not to buy. So I want to start discussing some opportunities, not necessarily to buy now, but something to track. So one is this platform itself. So we're using Zoom today because we cannot meet in person. And if you see what the stock has done, so always I compare it with an index. So if you look at Nasdaq, it's gone down 8% from the time that Zoom listed last year. And at the same time, Zoom has gone up 58%. So pretty strong rally. It's gone down a little bit in the last couple of days. Also, what is interesting is like most tech IPOs, it initially went down quite a bit, up to 25% down. And then once the virus thing came in, it started the rally. Also, people who were with us in January at one of our meetups, we discussed remote working as a theme for 2020. Not because of the virus, we were not aware. In general, as more and more tech companies, more and more startups are rethinking, people are thinking about work-life balance, spending time with families. This was what we discussed. So anyone at this stage, are you buying Zoom or have you got Zoom in your portfolio? Just out of curiosity. So you can unmute yourself for most people if you're in the app, or you can write in the chat. If you do write in the chat, please make sure that you change to, there's an option to change to all panelists and attendees so everyone can see your comments. If you do it to only panelists, then only I will see the comments. So anyone has Zoom? Okay, I'll assume the silence to be that you don't have Zoom in your portfolio. Okay. Right. So as value investors, yes, this is a good theme. It's a hot stock, but is it value? So let's have a look, right? So if you look at just basic numbers, it's a 37 billion in market cap. That's not cheap. Also a little bit about the history of Zoom, if people are not aware. So one of their competitors, which is WebEx, which was bought by Cisco. So one of the employees of WebEx ended up starting Zoom. It's quite interesting. It's probably a learning for someone acquiring a company to kind of protect itself from employees going and starting something similar, but I guess they were able to do. So one of the employees of WebEx has started Zoom. And I guess it's a phenomenal product. Conducting the webinar, it can allow us to have 10,000 people. Video calling works really well. So in general, I think a great platform. But 37 billion is not cheap. Now again, not just looking at the number in isolation, but let's look at some EPS numbers, right? So 2021, so this is from Yahoo Finance current year, its estimate is close to 50 cents. Now for a stock that trades at 135, 50 cents means a massive price earnings ratio. Of course, this number may be much higher, and I think that's what the the guidance from management is that it'll be higher. For example, we are conducting this webinar, we'll have to pay them for this. So it could go up, and then it's expected to go up maybe a bit higher. But this is an expensive stock. It's not cheap. So unless everyone kind of adopts Zoom, I mean, we saw the World Health Organization. We saw a lot of governments using Zoom for communicating with the public. So it is getting a lot of traction, but it's expensive. So I will just pause because this is supposed to be an interactive session, not just me talking. So thoughts, what are your concerns? Would you track Zoom going forward?
Yeah, I'm not really very keen on buying stocks from one company. I would prefer to have some stock funds because I think it's a lot better protected against.
So you buy mutual funds, you mean, or ETFs?
Yes.
Fair enough. Fair point. Okay. Vivian, you had some thoughts? Sorry, we can't hear you.
Sorry,
Yeah.
I wouldn't buy it. You look at the PE ratio is 1005. The coronavirus is at least right now a short-term event, meaning most people predict that things should be back to normal, quote unquote, whatever normal you call it, at least back to new normal within 6 months. You can't just base the number of people using a temporary spike in number of people using Zoom to justify a PE ratio of 1,500.
How did you get how do you get 1,500?
Sorry, I think it was shown on the Yahoo page you see just now.
No. So the ratio is, I think, it's about price earnings of about 200 and something, 270, because this is. Oh, sorry. Did you see?
Per shares. I'm talking about PE ratio. Look at PE ratio.
Yeah. But this is a trailing PE ratio on. So I wouldn't, But if you look at the forward, so they are expected to have a big jump in their earnings. So it's a company that's scaling. So I would look at the future. So let's say 300 times earnings at this point, but it could be a little bit lower.
Sorry, what 300 times earning? You're talking about earnings.
Price earnings. So see, the price is 135, right? And EPS is around 50 cents.
Yep.
So 270 it will be the price earnings ratio. So I think, so Vivian, but ignoring that, I think your point is valid, right? So is this and this is everyone's decision, is this a short-term phenomena, or are we going to change the fundamental way we behave? So from my side, to explain, our team has been using Zoom for a long time. We allow people to travel. We allow people to work from anywhere. And now people will see the benefits of, you don't have to be, traveling 1 hour a day for, basic meetings. Most of that can be done through Zoom and other resources. So you might see some positives coming out of that.
Yeah, I think it's going to maybe have a downturn if the virus is managed. So it can go up, of course, but I think it now peaks because a lot of people use it. But when the virus is gone, then it's going to go down a bit. But of course, people will have used it, and maybe once in a while they will use it again because they know the technology. But I think it's going to be used less frequently than it is now.
Okay, all right. So that's good. Okay, and I think Price has similar views in there. What was interesting in yesterday's webinar is someone pointed out saying, Zoom is predominantly focusing on businesses for now, but what if it were to open up also to, for personal use? So obviously people use FaceTime, people are on iPhone, people use Skype. By the way, I used to work for Skype. The platform has deteriorated after being acquired by Microsoft. So maybe even for personal use, they might have an opportunity. So that was yesterday. The other concerns obviously is competition. So one is there are some other players in the market. Also, as people see this sector being lucrative, there might be more competition coming in. But at this stage, as a tech entrepreneur, I still have to give it to Zoom, saying they build a phenomenal product in a market where there are other solutions, big solutions. So I'm personally tracking this. I wouldn't buy at this point, but if there was either a big drop in the stock price or they expand in other segments, I might consider it. All right, so let's move on. Right, so the other stock is Slack. Has anyone here used Slack?
Yes.
Oh, and
Yes,
what's
I
your
do.
feedback? What feedback from you guys who use Slack? What do you guys think?
I
sorry.
use it among it was with a group that I was in. It was not for a business purpose, and I don't know how likely it is for businesses to use Slack.
So we use it within our business, and we have done for a few years now, which is why I tend to use it. And it's my preference over like when I use Skype at work, like Skype for Business or Teams. So for me, that's the one that I prefer.
Yeah, so my feedback is similar to Yasmin. We've been using Slack for a long time, I think almost 5 years. And it's quite Slack was founded in 2009. So it's quite an old company. Phenomenal kind of product for what they've done, how easy it is for businesses, to run. Also, what is very interesting about this product is how ethical the management is. So I think one of you mentioned that, if businesses pay, we pay about £250 a month for my team of 35 people to Slack. And I think it's significant value for money for us. And I would even pay, if it was a bit higher with the product. So they are in a market where Microsoft Teams is one of the other options that Microsoft promotes. But it's really sad. I mean, Skype has struggled. So as a business, and Facebook has its own product, but we've struggled. So I think there's one comment from a Price as well. Love Slack as a tool. Yeah. I think with Microsoft Teams is kind of, if you are a IT person who is deploying software in your big organization, Microsoft Teams is an easier option because, it's kind of integrated within Microsoft products. It gives you tools to administer. So it's much easier. But I'm hoping that with what happened with mobile devices, with, bring your own device, similarly with Slack, if people demand that from their organization, maybe they'll do better. Now, in terms of the stock itself, it's actually not had a good ride. So if you look at from the time it IPO'd, it's gone down significantly. Okay. So in this period, while we've seen it going up a little bit, it's gone down 33% from IPO. And it used to be down about 55%. Anyone knows why the stock fell after the IPO? Okay, so basically what happened was Microsoft came up with an announcement saying Microsoft Teams has more daily active users than Slack. Okay. How would you read this headline for anyone who's used these products? So basically Microsoft Team pretty much forces you, if you're installed in your computer, even if you don't use it, it might automatically log you in when you, restart your computer, or if it's forced upon you. So because you're logged in, you're considered as a daily active user, but doesn't mean that you're actually using the product. And this is where I think people who actually use the product understand it more than market analysts. So I have been personally tracking this stock because I think it is good value for where it is, especially with the team and how they can expand. So one of the points that was made yesterday is that Slack is a much wider product, right? So there is, chat, there is file sharing, there is team management, there is, you can integrate with other things, and they also have video calling. So if Slack were to position themselves saying you could also do webinars with third parties outside your team, they could probably get into the market of Zoom. So yeah, and sorry if I didn't mention, this line above is Nasdaq. So they have underperformed Nasdaq even when it's going down. So, but of course, it's important to see the numbers. So its market cap is about 14 billion. So if you compare to Zoom at 37 billion, the downside is that it's still not profitable. Okay, so the company is still burning cash. Now, as you would know, with SaaS businesses, internet businesses, what happens is as you start scaling your product, your margin increases significantly. So every additional dollar of revenue, majority of that goes to profit. So this is one benefit of having a SaaS product, but it is negative. Also in comparison with how much they've raised. So before they IPO'd, Slack had raised something like $1.5 billion, while Zoom, I think, was about 150 million. So Zoom has developed this at a much, so your return on capital is also much higher on Zoom than on Slack. So I'll pause at this moment. So what do you think? Any thoughts from anyone? Would you track it? Would you consider it? So Price has comments. Price, I wish you could, you could have given us, you could have spoken. So Price's comments are, this is the Apple to the Windows Play, absolutely. Yeah, it is not easy, that I agree. Okay. Luckily, everyone can see his comments. Anyone else? Any other thoughts on Slack? Okay, we're definitely much quieter than yesterday. All right, let's move on. Hopefully, we'll have more thoughts on Netflix from people. So interestingly, Netflix is, in the last 2 days of rally, it has actually gone down, while everything has gone up significantly, which was quite interesting. I didn't expect that. So Netflix is one of the stocks that I'm looking to short, okay, not to buy. And my rationale here is that what has happened is we've had this period of obviously quantitative easing and, price earnings going up, price earning multiples, and Netflix has kind of remained there. It's actually not gone down. Sorry, Nikita, what are the two lines? Sorry. So the light blue line is the Nasdaq Index. So you see Nasdaq has gone down 18% in the last 3 months, while Netflix has gone up 5% in the last 3 months. So always comparing the, the performance of a stock with the index. So here you see that, so Netflix hasn't gone down in line with, the market. So still high price earning multiples. And obviously the belief is that as we stay at home, we're going to watch more movies, more content. I started buying content outside of Netflix and Amazon Prime just because pretty much watched most things I wanted to watch. Of course, there are other things to consider, like governments asking Netflix to reduce bandwidth because we need, we need to be able to work, and our internet infrastructure is struggling. We had this news from Mexico yesterday, wherein they're saying Netflix should have at least 30% local content, and it's not only about international content. On the other side, they have massive debt in the books, which they use to create their own content. And again, everyone has their own views, but I'm a little bit disappointed with some of the new original content that Netflix has come out with recently. So what it does is when it creates this original content, it creates an asset on the balance sheet. And to fund that asset, it's typically where they take a lot of debt to do this. So let's look at the numbers, right? 150 billion in market cap. It looks low compared to, if you compare to some of the bigger companies, but it is still quite a bit. And if you look at, it will make $6 in EPS, compared to a price of 350. So you're looking at 50 times, 60 times multiple. And when I look at these high growth companies, I'm ready to pay 60 times multiple if it's going to grow 60 times, if the growth year on year, which gives me a price earnings growth ratio of 1. So if you're growing by 30%, I'm ready to pay 30 times your earnings. But over here, I'm not sure. So unless it can grow much faster from this point, I think for me, it's a good candidate to short. And I'm a value investor, and we've had this discussion below. So just like I would like to buy undervalued stocks, if they're overvalued, I don't refrain from shorting. Again, I use more sophisticated investing and trading tools, so I can do that much easier than other people. The only thing that stops me from shorting this stock is there's one thing that I believe Netflix has under their sleeve, which I would monetize if I were the CEO, is it allows too many people to share the password, right? So you have 4 or 5 people sharing the same password. And imagine if Netflix were to come and say, it's 1 password per user, 1 account per user. So it might see a reduction in the number of viewers on Netflix, but then the subscriber number should go up. And then you could see a big jump in this earnings. But I think as the company philosophy, they're not doing that, but I can see if things go bad, they could do that. So I'll pause over here if anyone has any thoughts on Netflix. So I mean, price is obviously commenting, so we all can see that. Yeah, economics, yeah, that makes sense. Okay. Any other thoughts? What is the unmute code for the phone? Price, I have no idea. We probably need to test it. I try now. I've given you access to, do you have access now?
Yes, thank you.
Perfect. Yeah, good to have you. Yeah, go on.
Awesome. No, I was just checking. I think you're right. I think they're basically modeling it, so almost like a piracy model, right? They're cool with people sharing the password because it's sharing their breadth and like dominance in the market. But I wonder now that their quality is degrading, whether that move would actually work for them or just move people to other platforms faster.
Yeah. And with quality also, the struggle that they might have is, Disney has its own service. Other companies are starting other content creators are starting their own services. So they might not want to distribute their content through Netflix. So more competition coming in could also have an effect. So yeah. All right, so let's move on. So, I mean, for anyone who was here in January, we discussed some of these themes back then as well. But the themes that have been, what I have seen personally are obviously remote working tools, everything from video calling, collaboration, like Dropbox kind of solutions. I mean, all of these are pretty popular now. Second is kind of having worked in entertainment before, kind of the cocoon effect. When you're stuck at home, apart from having more babies, you're interested in more content. So, you are consuming music, videos, video games. So, I've never been a fan of video games, but to be honest, in the last 2 weeks, I have thought about starting to play video games just to kill time. I hope I don't get onto that mode. It's quite addictive. Online only services, Kato has done really well. So companies don't have a physical infrastructure. So I was reading this morning about how Primark and other companies are saying they're not going to pay rent given the situation. And so this is a kind of a very tricky situation that we are in. Pharma, I mean, I should extend this. Yesterday, someone pointed out to healthcare rather than just pharma. So obviously whoever comes up with vaccines, hopefully they won't charge us a lot, and hopefully they won't patent it. We'll hope that. And then essential services, right? From supermarkets. Someone pointed out yesterday about utilities. As people are staying more at home, they're consuming more electricity and other things. So this is kind of themes I see. Anything else from anyone? What do you guys think?
I think they were good categories, especially if you jumped on them when you talked about them. They've been great. You could have ridden these pops in the market.
Thanks, Bryce. Okay. Sorry, Diane, you were saying something?
Yes, I definitely agree. So I try to build my portfolio also with a lot of new technologies and just IT technologies because I think that's really growing and fast evolving markets.
Yeah. Cool.
I wonder if there's a potential too for, like, when you think about the popular themes, there's some themes that are just getting hammered. You know, if you look at oil, I know we're going to talk about that a little bit, but I think there are a couple of industries that are just getting underpriced as a result of everything that's going on. And so I think there's opportunity there.
Yeah, so Bryce will come to that discussion. I think the challenge we're facing with, with looking at things that underpriced is there are too many uncertainties. So we don't know, for
Totally.
example, we don't know which. So governments all over the world will have to make some decisions about who they support. They're not going to be able to support every industry, every company, every person. And so they will have to let some companies go bankrupt. Some industries suffer, like airlines, other transportations, they are struggling. And so for us, it's very difficult to know what the earnings are going to be. And again, if anyone remembers the last crash, the biggest impact came in once Lehman Brothers, went under. People didn't think that, we will allow such big companies, too big to fail, but it happened. Bear Stearns going under. So once we see one of these things happening, we might see a big reduction or a big dip in the markets. And sorry, there were more thoughts. You had say
yes,
something.
I wanted to say something. Can you hear me? Yes. I was just wondering whether this whole hype about coronavirus could be overplayed, and there might be a case for taking bets on the opposite view, whereby the coronavirus could calm down. I was talking to a doctor yesterday, and he was saying the Oxford study, I don't know if you saw that, that was saying that 50% of the population should have been already contaminated using Italy's data and research. They're saying we're probably already immunized in February, and the people who are taken care of in hospitals now could be, in fact, not people newly infected, but bad responders who also contracted in January, but have kept a viral load with active virus, which attacks deeper the lungs and the viscera. So therefore, all this confinement, if this kind of conclusions gets 100% confirmed, which is not the case at all now, could change everything around. And this perhaps sets a case for, taking a bet on the market, on a market rebound, just on the basis of, the research showing something different from the current trends of now. Do you see what I mean?
Absolutely. So, I mean, you can be contrarian in any kind of market scenario.
But I'm saying it might be worth giving a bit more chance to the contrarian view than until the last month. That's all.
So, Bryce,
I think.
Yeah, go on.
Yeah, I mean, I agree with you in one sense, and kind of slightly, I'm not so certain in the other. I think on one side, it's almost certain that we've got things that are oversold and things that are now overpriced as a kind of the long-term implications. I think people always overestimate the optimistic side, the upside to a potential market. So those are your overbought, and they overestimate the downside. So there's definitely a play there. That study, I think, was based on modeling. It wasn't actually based on human sampling. But
yes, it was
I
also based on Italy's. Sorry, it was also based on Italy's reports.
I mean, I don't want to go into it, but I think that's one study. But I agree with you. But the fundamentals, I agree with you that it's likely that things are oversold as much as I think some things are overpriced.
Thank you. Sorry,
I have a question. I mean, whether this is oversold or not. I mean, we all can have an opinion, and we all may be right or wrong at the same time. What I'm thinking about is, can this overselling of assets actually lead to a fundamental change it actually leads to an impact on liquidity and cash flow? which
Yeah.
is when the big, effectively that's a Lehman moment, right? Like if it actually hits liquidity, how likely, in your opinion, will we reach that stage, or is that basically?
That's a very good
won't happen?
question. It's a great question. So let's hold on to these thoughts. We're going to discuss this, and then we can go if any questions are unanswered. But I think these are exact things that come to mind. But just going back to the point that if you think you want to be contrarian at this stage, you don't necessarily have to build a portfolio of stocks, right? If you can manage to do futures and options, what I would do is I would buy out of the money call options at this stage. And again, it depends on when you think we will recover, and put some money that I'm ready to lose. But if you are right, you will make a lot of money. If you're wrong, you lose that whatever money you're ready to lose. But I think it's better than starting to build a portfolio at this stage, just my view. All right, let's move on. So it's pretty much what you guys were talking. So let's look at S&P 500, right? So I like this benchmark because it's got 500 companies, better than 50 companies and smaller indices. So we've come down from 3,500 to 2,400. I think it went about 2,500 right now in the last couple of days. So it looks like a massive dip, right? And I think for people who've been waiting on the sideline, people think this is a great opportunity. Unfortunately, for my experiences of seeing, two kind of recessions, and in between a lot of crisis, be it in, I think it was 2016 when China said you cannot sell your stocks, or India, where where I'm originally from, we had like a mid-cap crisis where I saw companies falling 95%. This doesn't look very exciting to me yet, personally. And the reason I say that is, so we'll come to the longer term chart, but let's similarly on FTSE 100, we've seen kind of similar dip, and people want to jump in at this stage. But let's look at longer term, right? So FTSE, so this is from 98. Okay. Now, if you look at the dips here, 2003, which was kind of, we were just getting done with the recession. In fact, I started a lot of my investing, putting a lot of my money in 2003, and I actually was quite lucky. It wasn't planned. And I did this rally, and obviously we see losing pretty much everything in 2009, and then we've seen this big rally. But currently, we are still way above where we were in 2009. Obviously, a decade later, you have to consider inflation. And so, yes, companies over a period of time grow because of that. But it's still a little bit long way away from the lows that we saw in 2009. So that's on the FTSE. So S&P, this is the one that I personally track. As I said, 500 companies. If you look at where we are today, we're at the same level as 2017-18. Now, I was mentioning to someone before everyone joined up on this call that I liquidated most of my positions in 2017. So I liquidated most of my European and US investments. I still hold companies in India that I bought in 2003, as I mentioned. Some I own from like 2000, which I will not sell. They are like really long-term investments, but I liquidated most of the other plays at this stage. And from 2017 onwards, I've been just using futures, options, other instruments that we will talk about, but not taking direct stock exposure to this stage. So yeah, so if you just compare where we were in 2009, like we're nowhere close to that, right? So it's just recovering. What was 2017? It's like post-Brexit, Donald Trump coming in, and obviously Donald Trump and everyone else have been trying to boost the markets, trying to, obviously appease to their investor, the donor base and all of that. And so we've kind of lost out only what I believe is the excess that was built in by all the fiscal and monetary policies. So I'll pause at this point if anyone has any thoughts or comments.
Yeah, so
where do you think the price, sorry, go ahead.
Sorry, go on one by one. I couldn't figure out who was speaking before Price, but Price, go on.
Well, I'm just wondering, like, you know, where do you think the bottom is? I mean, I think it seems like there's kind of general feeling that this is the first kind of bottom, but you'll see a kind of a second bottom. But it's like, for me, what I struggle with is with interest rates being so low, I don't actually know what is realistic when you look back 20, 30, 50 plus years. It's like it clogs and kind of puts static in your visibility of truly understanding what the price of the market is versus history.
Yeah, so Price, hold on to that. There are more slides exactly going deeper into that topic.
Cool.
Yeah, cool. Any other thoughts?
Yeah, I also was wondering, so I started investing in the stock market last month, but I saw some videos about dollar cost averaging, and so when the market goes down, you can buy more stocks, but I'm just wondering if it's going to go down much further, or is it going to balance and go up again? I'm struggling with that a bit.
Yes, we will talk about that. And good point on the averaging. So I think that's the right strategy. So if you do decide that, okay, if you believe that this is the bottom, I would not put all my money at the same time. So assume you wanted to put, I don't know, $100 in a stock, I would put 20 now. And then if it falls further, I would put another 20. And then I would put another 20. I'll give you an example. In my case, I was back in, I think it was 2010, and I looked at the Apple stock, and I looked at it and I said, wow, really cheap with where we are. They're getting so much cash in. And I bought the stock. I think I remember I bought it starting at $600. And then, so now Apple stock has obviously had a split. So, it's worth 7 times more than what it's quoting now. So if it quotes at $200, that means it was $1,400 when I bought. So I bought it 600, and I put, a little bit of money in that. And then it went to 550. And I put a little bit of more money in that. And then it went to 500. Then it went to 450. I'm not telling you, it was one of the biggest positions in my portfolio, and I was panicking. And I knew that I'm doing this. It ended up going to 390. And I can never forget that. Luckily for me, I managed to hold on to those positions, and then I ended up selling, I think, all of it at about 700. Still, if I would have held those positions, it'd be much more. But you're absolutely right on averaging, but just be prepared that there is a saying which is, the markets can remain, I forgot. So basically saying that you could become insolvent if you're not careful with the market. I'll try and find that quote, essentially. Right, any other thoughts? Okay, so let's move on. So this is what I think, Price, you were mentioning, right? So it totally depends on you where we think we are. So we know that we've hit a top. Okay, I think I hope everyone agrees that we are at this stage, right? We know this is the top. Now, what we don't know at this stage is, are we here, which is kind of the bull trap, or are we here, right? And it's totally up to you. My personal belief is we are here. And the reason I believe we are here is because the government and everyone's trying to push the economy up through stimulus. It's not coming up through the fundamentals. And the challenge is that we're just printing money at this stage. We're throwing money at every problem. We want to pay everyone. We want to, that's not the way how an economy works. And so we could actually see a much steeper decline. Like when I talk about recession, the things I've seen is where people sell everything. Right? You will see price earning multiples going as low as 5 times earnings. I've seen a stock at two times earnings. And I still wasn't confident I should buy it at that stage. I did buy some of that, and those did really well, but this could happen. And so if you sit on cash, so I mean, obviously, so my thinking is this, right? So if even if you believe that we are here, okay, if you still sit on cash, you might still be able to get in maybe 10% higher, 20% higher. But if you get in here, it's like a massive decline from here. Even with your cost averaging, if the stock falls 90% from here, it's a problem.
Mhm.
So thoughts from anyone? But I keep looking at this graph every time, like every bull run, like you have to see where we are. This is an amazing chart, you know, a lot of respect to the professor here who's done this. So I'll pause
Yeah,
here
I'm
for
with
any
you.
thoughts.
I feel like we're in the same place, the bull trap phase, or the effort to return to normal phase.
Anyone else?
So from your experience, did you see these kind of drops in previous downturn?
Absolutely.
I mean, actual indexes.
Yes, absolutely. And this is why I believe in this graph. It's exactly what I've seen in pretty much every state. And again, it's also because of the market dynamics, right? So if you think about, let's go back to when things start going up. So there's another chart which I could have shared, but this is where institutions would buy, right? So the smart people whose day job is to invest. Now, the unfortunate thing is most of the retail investors come in here. Okay. And so if you have never invested in the stock markets, and if you saw that your neighbors are becoming rich, or Apple did 100% return in a year, and you enter the market, unfortunately, for a lot of us, it means that we're reaching the top. So if anyone who has seen 99, 2000, like you would be getting into a cab and the cab driver would tell you should be buying stocks. And there is this new IPO coming out. So imagine like the crypto craze that you might have seen with ICOs. Hey, buy it for 20 cents and it will go to $5. That is what you see. And that's actually the reason in 2017 I exited, because I saw more and more people signing up to the meetup, more and more people investing, which scared me to an extent. Does that make sense?
Yeah. Thanks.
Yeah, watch the meetup attendance. That's what I learned.
It could be one of the alternative data, right? Right. Yeah. I mean, I remember one of the most successful meetups we had in London was we had about 120 people showing up, right? So on average, we get between 30 to 60 people, depending on a lot of things like, the weather and other things, or the location. But 120 people showed up, and this was because of crypto, when Bitcoin was doing extremely well. And these people would have never invested in the markets before. They don't necessarily understand finance, but they wanted to get in because people were making money. Anyway, so let's move on. Sorry, someone said something?
Can I just ask a quick question, Risbeth? Hi there,
Tom.
by the way. It's Tom from Cedars.
Yeah.
So effectively what you're saying is if we are in that bull trap, your recommendation is to move to cash. And in doing so, I guess it goes back to that age-old phrase, time in the market, not timing the market. So effectively by moving to cash, you're crystallizing a lot of your losses. But obviously that's steep decline is something to be deeply concerned of if we are in that bull trap. So what would your recommendation and advice be in that regard?
Yes, I will share my kind of strategy at this stage, but I would look at it. I would not consider how much loss you made on your positions, but ask yourself, would you buy these positions now? Okay. And so we're going to talk about what companies you should be buying. So for example, you need to make sure that the companies have a strong balance sheet, right? So Tom, if you have some companies that have enough cash, so for example, Apple, if you're holding Apple, even though I think it's a little bit overvalued, I wouldn't worry, right? They have enough money but if you're holding, so one of the shorts that I did going before even the coronavirus started was Boeing. Okay. And we discussed in one of the meetups, and it was because the Boeing's management was struggling, and not much to do with the crash of the planes, but the security measures and all of those things. And that stock is pretty much down 70%. And I exited by taking profits at about 70% down, which is phenomenal for me. But it is a company which is weak, right? Or if you look at airlines, if you're holding airlines today, if they're likely to be, they might be nationalized, right? We might see banks being nationalized, in which case you might not get a lot of money.
Do you think the same applies to funds as well with regards to the positions that they're holding? Because they probably would have seen this coming a little bit earlier and moved a lot of the fund into cash anyway. But equally, the price of those funds, like investment trusts, for example, are trading significantly at a discount at the moment to the net asset value.
Yeah, it's a good question, and again, something we discussed. So I think the difference to look at is active versus passive funds. So most of the money in the last few years have gone into, for example, S&P 500 passive funds, wherein the fund manager doesn't really have any control. It depends on how many people want the money back or are investing. So they will invest based on what the retail audience wants. But yeah, I mean, active fund managers, yes. But from what I've read, I think a lot of funds have been caught out where people didn't think it could be as big an issue. I think everyone was just being, so I think this was just going back, I think it was 2015 maybe, when a lot of funds said, the markets are overpriced, but then, and they stayed outside and they suddenly saw S&P 500 doing 20%. And so their clients were like, hey, S&P did 20%, but you were sitting outside the market. I would rather remove the money. And so everyone has just stayed in with funds as well.
Yeah.
And I think, so we are seeing the downturn on that. So yeah, so I mean, Tom, it's a tricky one, right? If you're already in the markets, if you're sitting on big losses, like you'll have to look at, see how much risk you can take. Can you hold these positions? Can you put more money in? Because we could, I mean, if someone finds a vaccine tomorrow, we could recover, right? So yeah.
Great, that's really helpful. Thank you.
All right. Any other thoughts? Okay, so let's.
How would you? Okay, this is going back in time a little. If we're assuming that we're in bull trap right now, and we might be going in, we might be even returning to normal at this phase, looking at how much the stock has risen in the past 5 days. How would you superimpose the events that unfold in 2008 onto this graph? Where would you put the Lehman moment when Lehman and Bear Stearns went down? Would that be return to normal phase, or would that be despair?
I would say return to normal.
Okay.
Because I think, again, I think we saw a similar thing, and people can correct me, it was a while back, but there was stimulus going in, and there is a big difference between 2008, 99, 2000 and now, and we will talk about it in a little bit. But basically, like no one expected Lehman, right? It was a complete change, and so I think yes, we were here with that, and then we saw the markets crashing after that.
Okay.
Yeah. All right. So let's move on.
Yes, I was wondering whether, when you talked about out of the money calls with long maturities, I was just wondering whether at some point it could be also a case for buying US blue chip corporate bonds. Like you're saying, Apple is expensive, but the corporate bond has less downside. So perhaps you could start with corporate bonds rather than the stocks when we start buying stocks.
You can. And I think the Fed is supporting the corporate bond market, which is great. But remember that, for example, a year back, Debenhams, right, which is massive in the UK, their bond yields were trading at about 40%. So you could get a 40% yield on Debenhams bonds, but then, pretty much lost all your money.
But not Apple.
Correct. I mean, with Apple, I think the yield is so low. I don't know what the yield is now, but you're probably going to get 2-3% return.
Not now, anyway. When we start buying individual stocks, I think it might be a case for considering instead the corporate bond.
Sure. But I mean, like with Apple, which is something that's so secure, you might not get a good return on your corporate bond.
Depends how far low it goes.
Yes, but is it going low? I would be surprised if Apple actually goes low because no one has downgraded Apple. The credit rating is still high. So where you will see, the yields going high are where the credit rating is coming down. So from a AAA to becoming a high yield bond, that could be there could be opportunity. So personally, where I moved my money and my family's money was to buy short-term debt. So mutual funds that give out debt for like overnight use or 15 days. That's where I put money because I wasn't sure where the interest rates were going, being so low. And usually in the debt market, the time that I have personally made money is when interest rates are coming down. So the bond prices go up. But the interest rate's already so low, like bonds are not very exciting for me. And they still have, you know, pretty high risk at this point. Yeah. So let's move on, guys. So yeah, so I think with recovery, and again, you know, when you talk about return to mean and going up, I think the challenge we face is everyone assumes that a recovery is always a V-shaped recovery, right? So this is an assumption that you talk to anyone, and it was my assumption when I started investing, right? So a vaccine comes out and we go back to normal and everything goes back to the same prices as before. But unfortunately, if you look back at history, and that's the only place we can learn from, there are other shapes of recovery, right? What if we go in an L-shaped recovery, which means we move sideways, right? So this goes on for 2-3 years. You know, even if we go back to work, we still have to keep social distancing. We still stop traveling because it's less safe. Every country may not want foreigners to come in to control. So we might just go sideways, right? And then interestingly, there are other kinds of recovery. So we could go U-shape, which is we go sideways for some time and then we recover. Or there's also W, right? Which is we go down, we go up, we don't go down again. And this is also possible as more information comes in. So any thoughts on the recovery before we move on where people think, actually I should have done a poll on this, or what recovery people think might be.
So generally, you have mentioned several recoveries, but how long do you think these recoveries usually take? Is it 1 year, 2 years?
Yeah, I mean, if I knew the answer, I would be a millionaire. So I don't know the answer. But if you see this one, right? I mean, I've got it from Market Business News. It showed, you know, 3-4 years of sideways movement. Mm-hmm. Even if you look at 2008, 2009, you had a sideways movement for a couple of years, wherein, yes, if some stock outperforms, you know, it would go up. But no one really knows at this stage. And, you know, which is why at this stage, you know, if I were to buy, I would buy somewhere, let's assume it's a V shape. Instead of trying to time this bottom, I would buy somewhere here, right? And somewhere here might be, there is more certainty, there is more clarity, but then I give up this return, which I'm fine with. Because no one can time this, right? I think Price said, or someone said about the time in the market. Sorry, Tom said, right? Price in the market, time in the market rather than timing the market. Does that make sense?
Yeah.
Yeah, I agree with you on, you know, it's almost better to just ride it when you know you're in the clear and heading toward the light than trying to time the bottom to maximize your returns. To me, it's a bit like trying to jump in the market when you know it's near top, trying to just skim off that cream off the top before you have a fall. I think as far as, you know, the recovery, we were looking originally at China as a model to extrapolate the rest of the globe. But I think that because a lot of other regions and countries have driven into kind of a different model of containment, you know, like if you talk about the herd immunity kind of discussions that are going on in the UK or even in the US, I think that what we're modeling out now, what we're thinking of is a more longer recovery, because what we're seeing actually in China in some of our businesses is actually a return to fairly normal. It's not 100% return in like a V shape, but the U shape was kind of, you know, mid-January to we're now thinking end of April. We're seeing, you know, 80-90% return to revenue in a lot of our businesses. So I think that's the China model, but I don't think China anticipated that the rest of the world would kind of go, well, what about herd immunity? Because I think that introduces a whole new complexity that no one can model really. What happens when countries that did lockdown and containment meet with countries that are doing kind of this herd immunity model or the kind of hope for the best and see what happens model?
Yeah, agreed. Okay. Any other thoughts? Okay. I'm just going to let other people. Yeah, I think everyone can talk. Okay, so let's move on. So one of the things, obviously, you know, we need to look at is ratios, right? How is it historically? So this is quite a long one, right? 1880. And again, take the data with a pinch of salt. So I got from this website. But if you look at historically, S&P 500 has traded between 10 and 25. That's it. So 25 is kind of the top. And if you look at, in the 2000, I think this is probably 2003, and then this is, it's probably going out of the graph, as you can see. This is 2000 after 2009. So right now we are at 18, right? So what do you guys think? Do you think then maybe 25 is the top and 18 is good? So should we be buying? Because, we could have been here. What do you guys think?
That's a difficult question.
Yes. Okay, so sorry, this was a bit of a trick question. So, and this data, I mean, it was pointed out yesterday, was probably not the best graph to show Salfa at a better graph, but just think about it for a second, right? So price earnings ratio is a combination of two things. One is the price, which is what we know, and then it's the earnings, right? Now with earnings, right now, when you look at 18.4 is based on what we think are going to be the earnings of companies this year, right? And those earning estimations might have been done before this virus came in, because no one knows. Now assume that now businesses are not going to be able to work for like 3 months in most countries. So earnings are going to go down. And when earnings go down and the price remains same, what you might see is actually this ratio going up. And so suddenly 6 months down, when people are recalculating their Excel sheets, it might look like S&P is at 65, right? And then you might see a big panic in the markets. So this is the uncertainty and this is where I wouldn't get into the market right now. It's because we do not know what the impact on earnings is going to be. Again, I'll pause here for a sec if anyone has any thoughts. Okay, I mean, another example I'll give you is, in a boom environment, okay, so as a basic step, right, most analysts sitting in investment banks, everything runs by an Excel sheet, right? And all of the future, I mean, some of it is learning from historical data, but it's all assumptions, right? So you might say a company will go quarter on quarter 5% or year on year 20%. Now, if that number changes from 20% to 19%, right? 5-year future projections come down significantly and you will see a 10% dip in the stock. Now imagine if those earnings come down, become half, or some companies become unprofitable. And you might see that happening in a recession quite a bit, that companies are changing their guidance, because again, we are a very interlinked society, right? A company, Apple, relies on a company in China. So if something goes wrong with Apple, this company in China suffers. And Apple might not know, the company in China might not know until it's too late. So it's quite tricky. Sorry, so someone wanted to say something? You right?
Yes. Yeah. Yes, I haven't looked at volumes, but when we see the spikes in volatility, I was just wondering if many people have a wait and see strategy, perhaps the volumes are low, and this could be part of the reason of the high volatility. Not all of it, obviously.
The problem with looking at volumes, and this is why people stop trading, is the volumes are now inflated anyway because of algo trading and all of that. So you don't really actually know the actual volumes unless you have access to some data that can exclude the algo trading volumes, which is kind of, I would think, bit tricky to do.
Okay.
So let's move on. So yeah, so we talk about this earnings estimate, and I can give you a feel about, from my side, I'm running a business. We had about 39 people before going into the virus. We've had to reduce now to 35. And it's still difficult to pay everyone's salaries. I'm talking to a lot of other business owners, and everyone is struggling, right? We went into from a time where everything was great. So people were investing, hiring staff, to suddenly there is, basically no revenue coming in. So even if governments were to pay 3 months salaries from my employees, I'm like, okay, what do I do after 3 months if revenue doesn't come in? As I said, we have been personally lucky that, with Cedars, we managed to raise a round just in time, and we've got some cash coming in. But what if one of my big clients, cancels the deal with us? It's really a matter of survival for a lot of us at this stage. And it's not only small businesses, but big businesses as well. So just keep in mind that any company risk you take today, please make sure they have a strong balance sheet. Please make sure they can survive this time. It's not just good enough to look at a price earnings ratio and say, oh, it's at 5, so it's cheap and I'm going to get in. So just going back to the basics, and I keep going back to this graph every time I get tempted to trade, you will see that you need to figure out what the intrinsic value of a company is, have some kind of margin of safety, and this is where you buy. Now, the problem is that it's very difficult to work out the intrinsic value right now because I don't know what the earnings will be. And at the same time, if you think they're overvalued, you could make money on the short side of things. If you're shorting something, just keep in mind that please put a stop loss because, I mean, as we've discussed, if you short at 100, if a stock goes to 200, you pretty much lost the full investment. If it goes to 500, you lost 5 times the investment. So make sure you have a stop loss at 100%. That's what I would typically do with short positions. Any thoughts for now?
I would tend to completely agree with you, Elizabeth, in reiterating what you're saying. Working with a number of startups, the majority of them have all gone into survival mode, and some are looking like they might well go under in the next few months in light of recent events. Obviously, there are companies that are doing quite well out of the situation, one of which is selling bamboo toilet paper, which I'm sure you can imagine is in quite hot demand. But generally the theme is everyone sort of locking up shop and going into survival mode.
Yeah, it's tough, right? I mean, having a runway of 6 months, 9 months, you're going to fail at this point, unfortunately. More thoughts? Okay, let's move on. Yeah, so this is the message that I want to personally, I believe in. Markets are cheaper, but they are not cheap. And also the fact that a stock can go to zero. I have seen a lot of stocks in my portfolio in previous recessions going to zero. And these have gone to zero, not necessarily because the management was bad. It could just be, external conditions. I had one company where they had significant amount of revenue, but they're selling to a government and the government couldn't pay those bills. And so they went under, but really strong fundamental business, but there's nothing you can do about it. Any thoughts on these points? All right, let's move on. So this is the phrase that most people use in a bull run to justify why they should be in the market. And I would generally say not to use it. I mean, most people will say this time is different, right? But in this particular scenario, I'm going to use it. So I apologize. And the reason and it's essentially comparing it to the last 2 recessions that I have personally seen. Again, if you have seen other recessions, please chip in with your thoughts on what you believe might be different or the case. So 3 things, right? One is we've never had a case where people are dying, okay? Which means that now governments have to, apart from bailing out people and everything, we have to manage, we have to survive. So we have to invest in healthcare, right? Countries have requested, Teslas and, car manufacturers to build respirators and, masks and all of that, which I think is the right thing to do. But unfortunately, that means that, it will have an impact on the economy, it will have an impact on company. And we will build through these things, right? So even if I lose money on my stocks that I own, I don't mind if, people are going to live. The second thing is, and it's one of the big issue, is that we've had quantitative easing in a boom time, right? This we've not seen before. And I will show you a chart after this. And this is the biggest risk. So countries are printing money right now. And this is a risk where, currencies might be worth less value. Countries might go bankrupt. What happens when we recover, with all this money into the system? Is it going to be causing, inflation? So there are a lot of these things that we've not I guess as a government, you really have no choice given that where we are, but we are in a really messy time. And third is, as we discussed, your passive funds where, it's just really dependent on how much money is coming in or how much money people want to take out. So this is why I think it's different from the last two recessions. And this is why I would stay away from investing. So this is the chart that scares me the most. So if you look at the previous two recessions, these are US Fed rate interest rates, right? We were, before going to the interest rates were going up, which is what you would expect, right? As things are booming, what central banks want to do is they want to control inflation, they want to reduce investment, so they keep raising the interest rates. And then when the recession comes, now a central bank has enough tools to keep reducing interest rates so that people start getting loans and invest more. The same thing over here. But look at us where we are now. We are already in negative interest rates. Why are we in this situation? Personally, I'm really annoyed with central banks for doing this. And this could be political pressure to support prices and all, but this is completely crazy. Any thoughts from anyone? Do people understand this difference? Is there any question for anyone who is completely new? Like, how does this impact us? Okay. All right, let's move on. So again, as I said, printing of money is not the solution to everything, but that seems to be only solution right now. And you can't build an economy based on that. So that's my concern. This was a blog post that I shared, and I think it was in the pre-read as well. So just think about how these things, are affecting, like we didn't have so much of index funds going back 10 years to the extent that we have now, where the money is going in. It's just because people had so much disposable income, unemployment being so low. But this time we might see some challenges. So this is my rationale for why this time is going to be worse than the previous times. And even if we recover from this point, we have vaccines, there will be issues for governments to deal with inflation and other things. Take a breather here if anyone wants to say anything.
So did you just say that it's not a good time to invest now?
Yes. I'm saying that the recession could be worse, and the implications could be not just short term, but medium to long term. Mm-hmm. So there are just too many issues. Like literally central banks are pretty much struggling to do anything other than printing cash, maybe buying bonds and those kind of things. And I, even as, having studied economics, I'm trying to figure out in my head, if, UK is printing so much money, US is printing so much money, how does it affect the pound, for example? But I don't have the answers. I don't know. Like people are comparing the debt to GDP ratio, which is pretty high in most countries now. So yeah. So the stock market is not a good idea to invest in right now, but it's of course a whole other topic. But is it going to impact the real estate market? Pretty much everything. I mean, real estate is already impacted, right? People are not buying new houses. So I live in Malta now, and my timing was so bad that I rented a place 1 week before this started. If I would have rented now, I could have got, whatever rent I would want to pay, because there's so much supply. So the last 10 years globally, people have looked at real estate as an investment because, oh, I'm going to do Airbnb. And now people are going to travel less, even after this, right? Because the virus, unless you have a proper vaccination, or maybe we have other viruses coming in the future, or if you're looking at it from just an investment perspective, you see that it's going down. So people might have negative equity, and so the banks might take over. So I mean, I usually never invest in real estate for other reasons, but I think it's going to be bad for every asset class. Any thoughts from anyone else who's in real estate? Okay. Yeah. So I mean, generally, my things, and actually I'm changing my thinking. So my plan in life as always was no mortgage, no marriage, because both of things, I think from what my experience, bring stress. So yeah, so surprise, we'll talk about gold. Actually, that's the next slide to come through. So yeah, so let's move on. So gold, and I think gold is quite interesting, right? So people look at gold as safe haven. I don't personally. For me, gold is something that my mom wears. I don't believe there's any value. I mean, Warren Buffett says the same, but people believe, and it's a kind of a self-fulfilling prophecy. The reason it goes up is everyone believes it's of value. So some of my friends, they buy gold coins because their thinking is money is becoming, is going to be worth less. And if you wanted to buy milk or bread in the future, you might have to use gold coins. And that is a completely screwed up scenario. But if that happens, that's what they believe. Now, with gold, what has happened is you've seen the gold price not going up as much as people would have expected. And one of the key reasons for this is because the US dollar has been very strong. And this kind of understanding is quite important. So when the dollar is so strong, gold becomes expensive in other currencies, right? So this is why the gold doesn't appreciate as much. And with the dollar, it's been a crazy ride, right? I mean, the UK pound, the pound was at up, I think, 1.30 against the dollar. Now it's at 1.19. It went to 1.14, I think. And so if you decide to buy gold, you have to decide which currency you will buy it in, right? And so you see the graphs look completely different depending on what currency you bought it in. Again, you have to consider, you might have converted your pounds into dollars. And then when you sell, you get, dollars converted into pounds, you get more pounds, but it's complicated. Yeah. Price, you had any thoughts on gold since you asked the question?
Yeah, I'm sitting in some gold, but that's more that I think it's likely to go up, and I just don't like sitting in cash because I ride the UK and the US market with pretty much all of my cash, and I'm just getting beaten up in the currency market.
All of us are, unfortunately. I just raised money on Cedars. It's all in pounds, and now I have to pay salaries in USD and other costs in USD, and it's a problem. Right. Okay, let's move on. So yeah, we're talking about pound, and it's one of the biggest challenges for my business personally because we're a tech business. Everything is in dollars, and this is not a great scenario. When I was discussing yesterday that I remember being in Las Vegas in 2008 when pound was 2. 1 pound is equal to $2, which was phenomenal time. Instead of going out gambling, I was shopping for 2 days because I just couldn't believe the prices. And now we're at 1.17. I think it's gone to about 1.20, but it's quite scary. And I think it becomes more and more important for most of us to not rely on one currency. So I'm thinking more about my family, like trying to have at least 3 different currencies where we have exposure, to not just rely on one currency. Any thoughts at this stage? Okay. So yeah, so oil is quite interesting, and this is the only position I have. I mean, I have my stocks in India, as I mentioned, but that I'm long. And so if you look at oil, historically, I mean, we've seen oil going down to whatever $15 over a year. But if you think about a longer term period, oil is at one of the lowest levels, inflation adjusted, right? And all of this started because of disagreement between Russia and Saudi Arabia and all of that. Now, when oil is at this level, essentially it's unprofitable for a lot of the oil companies. So one, they might go bankrupt, which essentially means that the supply will go down. 2, at some point, there might some sense prevail with Russia, Saudi Arabia, and all of these guys to say, okay, it's unsustainable even for us. And with oil, not only does it affect companies, but it affects countries. A lot of countries depend on oil. So for me, it was quite an interesting stage. So I bought some, again, it's averaging. So, I'm in loss from where I bought, but I'm going to buy more if it falls. The risks are obviously, we stop traveling, and so maybe we don't need use as much oil. But I think oil being at these prices is quite positive for emerging economies. So economies like India that wants to grow, and they do need a lot of oil. So yeah, so this is the only position I'm holding. Anyone has any thoughts on oil? We are a much quieter lot than yesterday. Yesterday I was worrying that we would go like significantly over time. Yeah. Again, just to kind of, and we discussed yesterday, even if you're positive on oil, if you decide to buy a company, be careful because you're taking a risk, company level risk. I am literally buying oil as a commodity, which I know it's not easy for some of you with your basic brokerage accounts, but just be careful. So when I buy a commodity like this, I'm not taking any management risk, any company risk, any balance sheet risk over there. My risks are much lower to that extent. What is the next one? All right, so volatility index. This is one of the most complicated products that you will see. Like if you ask me to calculate this, I'll probably struggle. But just to explain what it is it's called the fear index. Okay, so actually let's just read this, right? What is a VIX? So I put this down, read about it. So it's essentially looking at kind of S&P 500 index options. So what it looks at out of money calls and out of money puts. So people who are overly optimistic or people who are overly pessimistic, and basically a ratio of that. And so typically what happens is, so I'll let you guys read if you guys are reading for 2 seconds, or let's say 15 seconds. Yeah, so it's not going to be easy to understand, but if you look at now this graph, right? So if you look at typically trades between 10 and 30, right? Which means the volatility is not that much, it's okay. This is when typically S&P and other indices move like maybe 1% a day, maybe sometimes 2 or 3%. Now, when things go bad, like 2008 and, S&P and other indices fall, it could go up as high as 80. Now, when it's at 80, it means the fear is very high. And you see that a lot of people are, selling, people are nervous. Now, in the last couple of weeks, there were 2 days of continuous decline, and the VIX actually went to 80, which is somehow not shown on this graph. Okay. I play a lot in the VIX because I find it an interesting place to kind of, it's more my trading than investing. So I had sold VIX at about 64, okay, over here, and it suddenly spiked to 80. Okay. Now, if I had money, I would have, I took a big position here, so I didn't actually average because I thought 64 was quite high, compared to what we've seen historically. Then it went to 80. Now it's back to about 54. Okay. I sold it about 57 because I was unsure with the stimulus and everything coming in. So yeah. So anyone has played with VIX or knows how it works? And it's not just for trading, right? It could be a good hedging instrument.
Yeah, I use it for just to see what the market does and what the fear indicator is. But I didn't know you can actually invest in it.
Yes, you can, but again, it's not available through all brokers. And interestingly, almost every index has this now. So you could have VIX for FTSE 100. I think you can have. So you could use that, and it's a good measure of kind of volatility. So you can do that. Now, looking at this graph, if the VIX would go to 80, for example, again, do you think it's a good idea to short it? And is it a really low risk? Any thoughts? How high can a VIX go? Any idea, any numbers that come to mind? So from what I've read, and this was a question that I was asking, why don't I just short every time it's at 80 and then write it down, or always buy when it's like at 10 to write it up if it's kind of staying in that range. So it seems when S&P 500 didn't have any circuit breakers. Okay, so right now, if it falls 5%, if it goes 5% up, the index stops trading. So S&P fell 25% in a day. The VIX was at 150. Okay, so just because at 80 doesn't mean it's a sure thing that you'll make money. And if it goes to 150 from where you're at 80, you pretty much lost all your money. And if you have to sell. But I do play in this a lot because, and again, I've been tracking it for last, almost 5 years. So I'm seeing how it reacts to, the markets going up or down or something else changing. But again, it's not for everyone and it's not value investing, but I just wanted to put it out there that there are instruments that you could work through if you understand them without just building a stock portfolio. Right. So what are my strategies right now? Right. So one is I'm waiting for certainty. Second is I am looking for weak companies. So I look at companies where, not enough cash, they're struggling. I'm going to be shorting those companies. Now, some countries have put a restriction on shorting, which I don't think is the right thing to do. Shorting, allowing people like me to short brings liquidity to the market. So yeah, if I do decide to buy, I will be looking at strong balance sheets for sure. I'm looking for non-company related instruments. So like as I have oil or other things, and then try and hedge your positions, read a little bit more about options. Obviously you can lose a lot of money, so be careful with this. If you think the market is going to go up quite a bit, buy out of the money, call options, because then, this is the maximum loss that you will take. If you start building your portfolio, if stocks go to zero, it could be a much bigger loss. Any thoughts, any other strategies people are using, or maybe they disagree with any of these strategies?
I was just wondering whether there would be a shift to non-listed assets in terms of investments, because the market exaggerates trends in listed assets.
It's tough, right? I think from my personal experience, unlisted assets, the problem is liquidity. So let's say if you were to invest in my company, you would not necessarily be able to get out very quickly. While if you buy, an Apple stock, even if it's down 30%, you can get the cash back. So my personal view is unlikely that it will go to, in fact, it's a really challenging time for private companies right now. It was already a challenging time last year. So just to give an idea, last year when Apple returned 100% return, if someone has invested in my company, they're like, hey, why should I invest in City Falcon when I can make 100% in the markets? So it was already tough for private companies, and I think it's only getting worse. But you might get some distressed assets. You might get companies that are very good, and if you back them, when the recovery comes, it would be great. So I think there was one study we looked at what is the best time for you to start a private company or a startup, and they said it's recession, because if you can survive through recession, when the recovery happens, you're likely to make, likely to be more successful. Any other thoughts? Okay, so I think we're pretty much at the end. Okay, yeah, one more strategy that I use when markets are really bad is looking at enterprise value is less than zero. Okay, so this means that the net cash, so if you look at the cash in the books minus the debt, is more than the market capitalization. And in an ideal scenario, if the markets are perfect, this should not happen, right? But there are reasons, right? It's panic selling, those kind of things. So if that happens, this could happen. And I've seen this happening in the past and I've taken positions. So if you have a good stock screener like Finviz or something else, I would recommend keep monitoring, add some alerts maybe to look at undervalued companies. What I will warn you is be careful. Healthcare companies that burn a lot of cash, or financial services companies that need to keep money on the balance sheet for financial obligations might fit this criteria, but they might not be good investments. Yeah, so stock screener, I will just write it. I mean, I use something called Finviz. Okay, they should pay us for the marketing, but yeah, it's a good tool. For UK price, I think they generally have global companies, but it's usually more US focused. Yeah. Another question, sorry, I missed out from Nikita about spread betting. So Nikita, I've been doing spread betting for 10 years, but it's a very complicated product. Also with spread betting now, with what is going on in the market, most providers want you to take much bigger positions. So when I take, for example, VIX positions, they're pretty high, which means that I have to monitor my positions quite a bit. So I wouldn't advise anyone who anyone who was new to investing or doesn't know how it works to do spread betting at this point. Because remember, in spread betting, you can lose more money than the money you deposited. Yeah, price, Stockopedia is a good bet. You know, I met their CEO as well. It's paid service, so I think you have to pay 25, 30 pounds. But yeah, you could be using that as well. So yes, enterprise value less than zero. Just a quick plug for what we do at City Falcon. You know, I'm a news junkie. Most of my knowledge comes from that. So you could be using our platform. You know, most of the services are free. And I'd send out in the pre-read, I'd created a kind of a list of things that I'm tracking from oil, Ocado, you know, Zoom, or the VIX Volatility Index. So with the one click, you can build that watch list on your site. And you can start reading. We've also got mobile apps. Yeah, and so it's just to conclude, like investing in market, sorry, it's not a great analogy, but I think it probably gives you an idea is, you know, you're going to war, and going to war doesn't mean you just take your weapons and start attacking your opponent. You wait for the exact right time. And I don't mean timing the market, but just be smart about what you do. And I think that's what my approach with this as well is, just wait and watch for now. Yeah, that's it from me. That's the presentation. So we've got another 20 minutes. If people had any discussions on what we've discussed or anything else, we can do that now. You guys should watch the other webinar, or how many questions and comments came out last night. Anything else people want to talk about? We've got some time.
What were the key topics that were discussed last night, if it was such an active conversation?
No, it was the same topics, but it's just like the discussion, people sharing their experiences, you know, what their strategies were, those kind of things. Obviously, it was a much bigger lot. So, you know, we've got like 20 people now, but yesterday it was more than 40. So, yeah.
And so is it a good time to continue dollar cost averaging, or would you say just hold it a bit and then wait for yeah, but that's timing the market, I guess.
Yeah, I mean, personally for me, it's okay to not do things at some time, right? It's okay to stay out, just watch the market, you know, wait for more certainty. Because dollar averaging also doesn't work well if you are, you know, if you're looking at a falling knife. Mm-hmm. Also, as I said, if you could look at some instruments which are not, you know, I mean, I think as someone mentioned, I don't know if it was you or someone else, is instead of taking individual stocks, maybe take, you know, more wider exposure. So maybe buy mutual funds if you really have to buy. You know, it'll cover more companies, or buy things that are not company specific. Mm-hmm. But at this stage, I would not put my hard-earned money into the markets. And I could be wrong, and you might see a rally of 50% going next month if a vaccine comes out. And I'm happy to lose that, you know, potential profit from the rally. But what I don't want to do is risk my capital at this stage. Mm-hmm.
And also because it's global stock fund that I invest in, because the Asian market is coming up again. So isn't that going to balance it a bit?
I mean, it could, but again, your assumption is that Asia will recover. Again, we are a kind of an interlinked global economy. So it's very difficult for just one continent to do well and another to not do well. So it could be affected. So it's up to you about how much risk you want to take at this point. Also, just be careful, as I said, the distinction between an active fund and a passive fund, right? Because an active fund is where a fund manager can actually think and put their money, while a passive fund is really dependent on, the inflow and outflow.
Okay, thank you.
Cool. Anything else, or we close at this point? Take the gift of time. All right, cool. Thanks a lot, everyone. And we will do another session next month. So hope to see you guys then. Take care. Bye.
Okay, thank you. Bye.
Bye. Thank you.